By the second quarter of 2026, artificial intelligence successfully transitioned from generating text and images to executing complex, autonomous business workflows. Yet, exactly as the technology peaked in capability, the stock prices of the companies that built it began to violently fracture. The industry crossed the line from experimental digital assistance into the active deployment of multi-agent orchestration. We are seeing coding agents operate as full software engineers, and AI runtime layers merging directly into global supply chains and physical production. While 2025 was defined by unbridled momentum across mega-cap technology equities, 2026 is defined by a strict, punishing recalibration of valuations across the broader market. This disruption follows a shift in the limiting factors of the industry. The constraints of algorithmic innovation and silicon fabrication have been joined by a different set of variables. The expansion of these systems has become tethered to terrestrial physics, specifically the availability of gigawatt-scale power, data center real estate, and raw material supply chains. Navigating this autonomous era requires abandoning legacy software investing heuristics. Capital is aggressively rotating toward a macroeconomic model focused on heavy industrial infrastructure and the complex debt mechanisms required to build it. The technological performance gap between rival foundation models has evaporated. Over a highly compressed 6-week window in April 2026, the market saw the concurrent release of multiple frontier models, confirming that the race for intelligence lacks a definitive winner. This chart shows capability clustering. GPT 5.5 dominates terminal execution, while Claude Opus 4.7 holds an edge in rigorous engineering. Then DeepSeek V4 entered. This open-source model proves China bypassed export controls, matching top-tier intelligence at a disruptive 14 cents per million tokens. Because these models rapidly leapfrog each other in performance and cost, hard-coding any single proprietary system into a corporate infrastructure immediately compounds technical debt. It has become a massive financial liability to lock into one vendor. Consequently, the architecture standard is pivoting toward multi-model routing systems. These unified API aggregation platforms dynamically direct computational workloads across various models in real time, optimizing each query based strictly on competencies, latency, and cost. Model intelligence has been commoditized into a highly routed, interchangeable utility. The market recognizes this, and the massive valuation premiums previously awarded to singular foundational software developers are no longer mathematically justified. This structural vulnerability triggered a concentrated market shock in the first week of February 2026. A violent sell-off swept through the Russell 1000 and broader technology sectors, distinctly visible in this terminal heat map tracking deep intraday drawdowns. Institutional capital began aggressively divesting from companies reliant on monetizing structured, knowledge-based workflows. Because autonomous multi-agent systems can write code, debug infrastructure, and bypass traditional interfaces, generative AI is a severe deflationary threat to legacy software models. This graph tracks the historical price-to-forward earnings ratio of the software sector. Sitting in the most expensive 10th decile at the start of the year, the realization of this vulnerability caused the sector's premium to crash violently down to the 8th decile within days. Equity markets are now deeply divided. On one side are the AI adopters, companies successfully integrating automation to drive massive cash flow margin expansion. On the other are the AI disrupted, service industries facing existential obsolescence. The financial system is actively punishing visionary corporate rhetoric. Capital is migrating exclusively toward businesses that can prove immediate operational resilience and concrete cash flow visibility. To understand where that capital is going, we must look at the physical layer. An AI training cluster, operating continuously, now demands between 1 and 2 gigawatts of baseload electricity. The United States electric grid is structurally unequipped to handle this load. Utility interconnection queues, the waiting periods to plug new industrial facilities into the grid, now stretch between 5 to 10 years in prime development regions. Based on current capacity curves, domestic data center infrastructure will face a severe structural deficit of 49 gigawatts by 2028. Beyond domestic power, the hardware supply chain itself is rigidly constrained by invisible material bottlenecks that possess zero elasticity against macroeconomic shocks. In early 2026, kinetic strikes in the Middle East damaged Qatar's Ras Laffan complex, shutting down 30. In January alone, Meta locked in definitive agreements to secure over 6 gigawatts of continuous, zero-carbon baseload power. The artificial intelligence deployment curve has hit a wall of physical supply. Future scaling now follows the control of raw materials and the acquisition of zero-carbon baseload energy. The sheer capital intensity of this physical build-out is rewriting corporate balance sheets. Major technology conglomerates are now allocating up to 57% of their total gross revenues directly toward capital expenditures. This stacked column chart outlines the staggering volume of capital required. Forecasts indicate global data center construction will absorb approximately $2.9 trillion in total investment between 2025 and 2028. Because these expenses are highly front-loaded, hyperscalers cannot sustain deployment strictly through operating cash flows. To bridge this gap, off-balance sheet joint ventures are fueling an $800 billion expansion in private credit. These highly indebted infrastructure projects are structured in vehicles that remain legally remote from the cash-rich technology titans sponsoring them, introducing a substantial layer of opacity into the credit markets. This historic accumulation of infrastructure debt is colliding directly with a macroeconomic environment defined by sticky inflationary pressures and a higher-for-longer interest rate regime. The artificial intelligence boom has spawned a heavily levered financial ecosystem. The cost of servicing this massive debt makes the global economy acutely vulnerable to sudden bond yield spikes and the risk of cascading defaults in private credit markets. Navigating this complex intersection of physical constraints and massive leverage requires a highly tactical mandate. The simplistic strategy of passively holding broad, market capitalization-weighted technology indices is definitively over. Chief investment officers across major financial institutions are universally advocating for a bifurcated barbell portfolio strategy. The right side of this barbell demands an aggressive rotation of capital away from foundational model developers and toward second-order beneficiaries. These are the physical enablers of the AI boom. The strategy targets hard assets, grid modernization operators, regulated nuclear utilities, specialized commercial data center real estate, and ETF vehicles like Grid that track long-duration, policy-supported infrastructure. It also targets neutral semiconductor enablers. Pure-play logic chip fabricators like Taiwan Semiconductor Manufacturing reliably extract margin regardless of which technology giant eventually wins the frontier model war. To perfectly counterbalance this high-growth infrastructure exposure, the left side of the barbell requires heavy allocation into resilient incumbents and high-quality fixed income. Resilient equities possess deep regulatory complexity, entrenched physical distribution networks, and proprietary closed-loop data ecosystems that AI agents cannot scrape or replicate via the public web. On the fixed income side, allocating capital to asset-backed private credit allows investors to sit higher in the corporate capital structure, securing contractual yields that remain heavily insulated from sudden multiple contractions in the equity markets. These floating-rate debt instruments provide critical portfolio ballast, protecting yields against persistent inflation and localized geopolitical shocks in the raw material supply chains. Success in the 2026 autonomous era demands an abandonment of speculative software exuberance. Market participants must instead surgically exploit the physical energy bottlenecks and massive financial leverage that truly underpin the new global supply chain.